$5.90 an ounce. Now some thoughts on the market from David Brochu of Strategic Point Investment in Providence. We noted that auto sales last year were terrible, and you have even worse statistics about the stock market over the last 10 years, right?
Yeah, the last 10 years have been the second worst 10 years in the stock market forever. The only worst one being 1930 to 1940. The S&P, the broad measure, was negative 24% for the 10-year period. And, you know, we've been on this program for years now saying that we're in the middle of a secular bear market that's likely to go on for as much as 20 to 30 years. We have a lot of structural imbalances in our system, and we're still in the thick of it. We're still right in the middle of it.
Well, you're such a beacon of hope.
Oh, I know. I'm getting it lately every time I leave here.
So what are investors to do? If this bear market is going to continue, where do you make money? You
have to trade. You cannot. Buy and hold has been dead for some time now, and we've sang its eulogy at this point. It's over. It is. You cannot sit still. You must understand that this is more a gambling environment. It's more of a trading environment than it is an investing environment, and there are sectors where you can make money, and right now is a perfect example. We're in a liquidity bubble. This will continue for some time, so it is likely we'll continue to see the markets go up. We've actually increased our equity allocation slightly, but it's not because there are good investments. It's because Ben and the Fed are pouring money into the system, and until they stop doing that, things will go up. But when they stop, it's going to get ugly.
All right, so what sectors do you like? It sounds like Ben.
Yeah, tech is good and banking is good. Banking is good because it's a ward of the state. It's not going anywhere. If there's any problem in the banks, they'll pour more money into the banks. They're simply not going to let them fail. The tech sector is doing well. We're starting to see movement in materials. What we really like are commodity-based countries. The really first world countries, the UK, the US, Germany, we're overextended. These markets aren't free anymore. The government's involved. We like Canada. We like Russia. We like Australia. We do like the emerging markets after they correct a little bit. They need to come down a bit. You just have to be careful, very, very careful, and watch out for the Fed. Everything right now hinges on what the Fed will do with interest rates.
All right, the Fed aside, it sounds like, are you suggesting the easiest way to invest in these countries is through mutual funds that focus on these countries?
You pretty much have to. You use exchange-traded funds, or mutual funds. Generally, we like unhedged, meaning they're in the local currency, not hedged back into the dollar, because the dollar over the long term is going to weaken as the Fed has to maintain this policy for much longer than most people think. It's not going to be over in 6 months. I suspect the Fed won't touch rates until well into 2011, maybe 2012.
All right.
Before they touch rates.
We thank you for your observations. As always, David Brochu, Strategic Point Investment in Providence. That's our business report. It's time now to check the weather and our continued bitter cold in some